What is up, everybody? Welcome back to the Russell Journal. My name is Russell, and this is my journal entry for Monday, November 21st, 2022. So, if you're here, this channel is all about kind of my journey to becoming a professional day trader. We've basically hit the bottom, scraping the bottom of the barrel here. I got about $38 in my account, of which I took the last $30 and I put over here into this put expiring tomorrow, and we'll see. We'll see how it goes. I'm going to show you the reason why that is what the decision that I made and the last $30. Overall, I'm at the point where I realize I do have to make some changes and do something differently. We went from $1,000 down to $30, so all right, whatever. As far as the title of this video, stock market clickbait, Thanksgiving trading. This is really kind of a crappy week for trading. It usually is. You can tell from like the volumes, which are down here. Sorry, the volume's been kind of dropping off, fading, going into the holiday week, and this is fairly normal. We're going to take kind of a wing and a prayer shot at this and come back mostly in December and do a little bit, ramp up the account and come in with some more precise trade styles and stuff like that. So trade systems and things of that nature. I'll keep you all apprised of what we're going to do and how we're going to do it. But really, going into this, my goal of making $125 a day, there's two things I noticed. One is that in weeks like this, if that's my goal, if I need to be that consistent every single day, you're going to wind up with some problems because these ranges are pretty tight. You can see back over here on SPY, our top is at 402. And as of today, we've only closed right around, 394.5, kind of in that area. So you really, we reached this peak like a week ago, and the range has been so tight in the last 8 trading days. There's not really, it seems like there's a lot of opportunity, but there really isn't. And the reason there isn't is because in this tight trading range, there's no room for confirmations. So you're really winging and praying it, and so it really becomes difficult. If you are somebody who is trading longer than day trade setups, if you're trading the leap setups, it's probably a really nice time to load into some puts. You can go back over here and see the VIX is down. So puts are very, very cheap. So if you're trying to put on your leaps for next year, it's a great time to be doing that. Also, if you're looking to get long on something too, it's very low risk, high reward sort of situation in the longer term trading for the longer term traders. For the day traders, this is a certain type of purgatory that is known as the holidays. If you're a trader, you will know that traders tend to hate holidays and weekends. We like to have the days where the chart is open and we're working. Okay, so all that. Tons of stuff has happened. I did take a week off and try and get my head back around sort of everything that I'm doing as far as trading, my head back around as far as everything that I'm doing as far as the Russell Journal is concerned, what direction to take this, how to do it, what's best for you, the viewer, and what works best for me as the host and somebody who's trying to get all of this information out there. So there's a lot of stuff. Now, we're not going to cover most of it. We're just going to kind of jump right back into the charts and some stuff. So going forward this week, you have Monday, Tuesday, Wednesday as far as trading, and then you have Friday. Black Friday is typically a dead day in the market. Everybody just doesn't come back to trade. One of the things you'll notice from the volumes that are dropping off, again, like I said, your A-League traders, your guys who got the big money, your plungers, the guys who are willing to move the market around, they just left. And you can see here, check this out. So you had this big run up, they rallied on that, got up here, and you wind up in this like distribution pattern up through here, and which was really interesting because my brain, when we're seeing this distribution pattern, I'm like, oh yeah, we're coming back down, we're coming back down, we're coming back down. And then it's just been this slow grind fight all the way down. The only way to capture these is if you knew that the futures guys were going to make some of these gap downs or caught it back into the, or played all the gap fills. And just so you know, like if you go back, you can see this massive gap here. Fading gaps has not worked most of the year. It's only been in this last couple of days, in this last run up this year, that we've seen the gap systems, the gap trading actually work. Most of the time it's been gap and go. It has not been gap and fill or gap and trap, as they like to say. So really, it really complicates things, right? It complicates your mental. And I'm trying to break out of being, what do you call it? There's a certain novelty trader, right? When I had most success, my go-to move was a long move on a VWAP reclaim. Okay, this is the thing, right? And that move in particular, I was successful at until I wasn't. That stopped actually working. We stopped having VWAP reclaims, or you had people start manipulating VWAP itself by suppressing the price and just bringing the averages into price instead of bringing that price back up to averages. So you've lost a certain element of bullishness in that it doesn't really work anymore. Get back into a real strong bull market. Yeah, we'll jump right back into that's a great setup. The VWAP reclaim, fantastic. Okay, but as of right now, it's a bear market. It's not really working. Okay, so where are we at as far as what's going on with SPY? What is happening? Okay, well, you've got this tight trading range. Okay, so if you're in here, you have a pattern now of lower lows, okay, and lower highs. So your trend is bearish, but your filter is above the 18-day moving average, okay? Your bias is a long setup bias, okay? The one thing about it that comes into here is down here on your slow stochastic, you've lost your embedded reading on the slow stochastic. Okay. Now this favors a move back down here to the 386 range, where you're looking for what you'll be looking for is the move to the 18-day moving average. This is as Ira Epstein teaches it, and that's why I went ahead and put on this wing and a prayer trade over here. Ira, I hope your system works on this one, because if it does, I'll be back in the game. Anyway, but really there's some stuff that is happening here that is a caveat that may prevent this. It's holding up the market. And namely, what's holding up the market right now is the Dow Jones. So we're going to go over the DIA sign or symbol, and we're going to check out the Dow Jones. It has been the leader of this, and it is holding up the market. Okay, so you can see you got the bullish embedded reading on the Dow Jones. Even though you got a down day, you do have a pattern. You've still got the higher high, higher low here in that situation. Things are still fairly bullish on the Dow. Why is the Dow up? Well, the Dow Jones is a lot of your defensive plays. It's your industrials, it's your utilities, it's your things of that nature. That it's really tech averse. And tech is the one. The tech is the bastard child of the stock market right now. So people are rolling into these things that probably are going to do pretty well once inflation starts to abate, and they're going to be the first ones to really move once inflation starts to abate. But the real question is when and if inflation is going to start to abate, and how high do interest rates have to go in order. How much higher are they going to go? Now, we did last week get James Bullard came out and said that the interest rates are going up to 7%, or that they should go to 7%. The market doesn't really buy that. The bond market right now is calling the Fed's bluff. Okay, that's what's really happening. Bond market is calling the Fed's bluff. Now, this is what I think about that. This is not what will happen, but this is what I think about that. The Fed needs financial conditions to stay tight. They need those bond yields to keep going up. They need mortgage rates to stay high, okay? They need to do this because and especially mortgage rates, right? The bonds, I don't know how much at the moment the Fed cares about the bonds. What I do know is that the Fed needs mortgage rates to stay up. And the reason they need them to stay up, okay, is because one of the stickiest parts of inflation is rent, okay? Rent continues to rise. I personally just got the lease, the letter off with my new lease offer already for next year. I'm up another $150 from where I'm at now. It's insane. It's crazy. It's insane to me. Seriously, I don't get it. Why they would do that? They're not helping at all. I think my landlord hates America. That's what I don't really think that, but okay. Okay. So the reason, though, okay, now if you've rented much like I have for very long, one of the things that you will know as a renter is your rent never goes down. Your landlord is never going to call you and say, hey, I charged you too much, let me charge you a little less, right? Let's lower your lease payments, right? That's never going to happen, okay? What can happen with rent as it is that rent can just stop going up. They can leave it with no raise in it, without raising those rents for a couple of years. They might be fine with that. As long as they're making their payment on your rental, then whatever. Okay? So the thing here is, with the rents going up, right, the reason the mortgage rates matter is because the Fed doesn't call your landlord when they do the CPI data for rent. They don't call your landlord and say, how much are you charging for rent? Right? They don't go survey prices in different markets for rent. What they do is they call homeowners and say, hey, how much do you think, if you rented your house out, how much do you think you could get for it? Right? Now, if mortgage rates slip and housing prices fall, right, the people they're calling are going to be more concerned and think that they can get less money for rent. And that's going to show rent is going down. So as far as CPI is concerned, those mortgage rates need to stay high until we get those numbers, those readings that show that at least 2, possibly 3 CPI readings that show it's falling, right? That show rent is falling. So that's going to be really important. Here's the deal. If you don't get that, okay, if you don't get that in December at the FOMC, if these financial conditions loosen too much and the market gets way too far in front of the Fed, okay, if that happens, okay, Powell is going to come in with a baseball bat and take it right to the market's knees, okay? He will do a 75 basis point hike. He might even do a 100 basis point hike. And the thing that's crazy about it is none of the media is talking about it. Now, I talk to a lot of traders, and we're all very well aware that this is a possibility. So this whole thing here needs to take a break. They need to cool this down because, I'm not joking, if they get too hot here in front of that December FOMC meeting, Powell will bring the Jackson Hole speech right back up, right? He will do that again, and you will see some nastiness in this market, okay? Now, again, this is why, another reason too, especially ahead of FOMC minutes on Wednesday. We get FOMC minutes on Wednesday, and we're looking, I think that coming back to the 18 ahead of those minutes is a good idea. I think it's a smart idea for the market. I think the market maker would do well, because there's a lot we don't know about what's going to be in those minutes, okay? If those minutes say a lot about a 75 basis point hike, if there's a lot of stuff in there about that, then this market will definitely take a dive. So if I'm the market maker, I'm going risk off, right? I'm going to hold up there at the 18-day moving average. Now, the other thing about it, which is great, and another reason why you should probably wait until Wednesday if you're looking to get long, unemployment claims come out on Wednesday. Here's what we need, okay? If you're bullish and you're running based on the Fed pivot thesis, again, not my thesis, but if you are, you have to realize that this is the first week that you're going to get some actual unemployment numbers that matter. Okay. The thing here is tech did a bunch of layoffs last week. Unemployment claims start today. Okay. This is Monday. If you got laid off last week, you will file your new claims this week. Okay. You will file them on Monday. So what we will get is some of the stuff over the last 2 weeks, some of the layoffs we've seen, the 10,000 employees from Amazon, the 11,000 employees from Facebook, the numbers are going to start to climb up here. So if you are bullish on the market because of a Fed pivot, that unemployment number is going to should come in higher now than before. So you should start to see that move. Now that on Wednesday, after the numbers come out, could lift the market. If you do not see that, okay, if those people manage to just leave Twitter, Facebook, Amazon, and go find a new job right away, not file unemployment, whatever, okay, if you're still in that 220, 240,000 new claims, staying around that 1.5 million claims market, you are definitely going to see this thing come on back down, because the Fed will still have the market, by loosening, gives the Fed reason to raise. Unemployment being high or being low gives the Fed reason to raise. They can hold their argument, and this is one of my theses, is for a soft landing. Okay, that is a possibility. It's a hard possibility. If the Fed doesn't break something, that is going to be very difficult. Okay, but in the event that they don't, these are the things that you need to see, and that will cause the market to rally. You will see us come back up to this upper Bollinger Band. Okay, and that's a lot of the reason why you've had a lot of support through here, is because the market is just really not sure. They're pretty positive that the data is going to start stacking in the favor of a Fed pivot, or at least the Fed slowing down, and then into the Santa Claus rally. Okay. Now again, my two theses that do exist are: one, Fed is for the soft landing, which you won't see until June or July of next year. The other one is really for a market crash in January. And I'm with Kathy Wood and Steve Van Meter and some of those other guys on the idea of actually a deflationary crash, right? You get into January, you finally get the supply chains opened up and really running, and when that all sort of starts to happen, all that inventory hits the market and it's going to be led by retail. You will see, Walmart and Amazon and really and Target even take an even bigger hit in their retail sales with this, and you'll have that deflationary crash because they just got to dump that inventory. Okay, and that's what I think. I think you will get a crash. I think you will have a glut in your a real backup, and that will lead to a crash. Again, I don't think it'll be a big crash. I think it'll be kind of another 30, 60 day sort of deal, like when oil, when you have a glut of something, it causes some pain and some immediate hiccups and stuff like that. But it also allows for some really good, especially inflationary, correction stuff. So if you have that crash, if you have that deflation happen all of a sudden, you can pivot back into low interest rates and things of that nature. So I don't think it'll last very long. But if there's plenty out there that think it's going to be the end all, the be all, the depression of all depressions, world depression 2, as far as stuff goes. I don't think so. Okay. Now, so as far as our technical analysis, we're going to go back in. There's a couple of things that we have to look at. So we've looked at the SPY. We can see that we're weakening. We're beginning to lose it. Should be headed back to the 18. The Dow does have the trend up, bias up, and it's still somewhat embedded as far as things are concerned. And you can even see how curved up it is. So there is a bit of divergence. In the Dow, it's still looking the strongest. I'm still not putting a whole lot of credit on that, especially relative to the SPY, because we're gonna go look at XLU is the first one. This is if you are an S&P person and you don't do the Dow, you can come into XLU, and you can see this is pretty strong movement up in here. Okay, you've got your trend up, you've got your breakout set up right through here. You've got your embedded slow stochastic. Okay, so your trend is up, your bias is up, and the momentum is definitely bullish embedded. So they're moving in here fast. And a lot of the reason they're moving in here fast is because they're probably thinking what I'm thinking, and that's here comes the crash in January. And this is typically one of your most defensive sectors. Is XLU. So they are coming into this. This is not leading the market. This is the market running away from everything else. Okay. Now, where you will really start to see your crash, though, is once you lose that embedded reading on the slow stochastic on XLU. We're going to go look at one other one. We're going to look at XLI as well. And this is the industrial sector. I'm thinking.
XLUXXD.
Should be, well, we'll go look at, so we'll skip that. We're going to look at semiconductors. So, XSD. Okay, so the thing that's cool about XSD, look at XSD, very similar chart to SPY, okay? You're looking at this really wants to see growth come back in, but this chart is just almost identical to SPY. This is your semiconductors. Again, I'm not entirely sure why semiconductors have had this run. You can look at some of SOX and some of the other semiconductor plays and see. But you can see down here with our slow stochastic, we are starting to lose that embedded reading as well. Semiconductors, tech, things of that nature tend to make up about 27% of the S&P 500. So when they start to move, they move other things with it. Again, I also expect to see the Dow Jones diverge from some of the tech-heavy indexes. That's probably going to happen. And the Russell IWM will probably hold up there. So we're going to go back to SPY. We're going to wrap up this thing here with our technical analysis, where we're going, what we're doing. So again, expecting a pretty big move overnight tonight with the SPY. There is one other thing I want to bring up here really fast. SPY has recently released, they're doing options that expire every day now. So you have 0-day expiration options every day. One of the things that is going to create a problem on this chart and remove a lot of the opportunity is that. Because you will be looking at guys selling options every day and defending those options. And you are going to look and see a real serious liquidity trap be built almost on the daily. So I expect these big awesome swings in the daily, the day trading range, to go away. Okay, it's going to be a lot more fakey. Okay, where you're going to have to start to look as far as this stuff goes, you're really going to need to start to look at watch the futures guys and what they're doing. They don't play this little BS game. They do have their problem. They have liquidity traps. They do have weird options expiration, stuff like that. So we need to be careful going forward, especially into next year. I'm going to bump this account up to probably about $10,000 coming into January and see what we can do with that. Look to play some really long-term contracts and stuff as far as that goes. Anyway, that should do it for me for today. Again, watch that 18-day moving average. I think that is where you're headed. Hopefully tomorrow. It is Turnaround Tuesday. We had a down day, and you also had a down VIX going into today. But we'll see. That usually means you're 2 days from within the next 2 trading days, you will catch a rally. But we'll see. Right now, it sort of depends. It seems like nobody's here. So the volume is really low. The ranges are really tight. It's definitely, if you're making money on the short side, you can agree that it's definitely a battle. Most of the moves are in that have a lot of downward pressure on them, but the bulls are definitely buying support here. So until tomorrow. We will be, I should let you know, we will be off for Thanksgiving, and we're probably going to be off the first part of December, depending on how things go. I got to go back to, I've been in Vegas here, but I got to go back to Seattle on Wednesday, so there will be no Wednesday show either, just today and tomorrow. So if you don't watch a show, I'll get back to you probably second week of December. We'll see how it goes. Anyway, for the Russell Journal, I'm Russel Liss. The Russell Journal is written, edited, hosted by me, Russel Liss. We are produced by Social Media Shows. Our executive producer is Maria Pureza. Check out Social Media Shows. If you would like to do some type of show like this, it's wonderful. I don't have to learn about lights, cameras. I don't need to know anything about operating software or streaming or editing. I just show up and write my content. And I write my description. I prepare what I'm going to talk about for the day. It's great. So I don't have to do anything. So if you're interested in something like that, you should definitely check out Social Media Shows. Give Maria a call. She can do a great job. Anyway, and until tomorrow, just pretend I said some sort of catchphrase.